Now, in a main newsletter, you said markets are being manipulated very heavily these days when talking about the global scene. What did you mean by that?
Well, the policymakers who we believe were, more than responsible for what led to the financial crisis.
Right.
I own no bank stock from '04 to '08, which was basically a way for me to say that we were in the middle of a credit bubble of epic proportion in the U.S. but in many other places.
Explain quickly why you stayed away from banks when on paper, including Fannie and Freddie, they look cheap. You mentioned leverage.
Because the banks themselves became more and more levered, but we also could tell that they were making worse and worse loans. I mean, securitization basically allowed banks to lower their standards in terms of lending because they knew that once they would originate the loan, they would repackage it and sell it. So, there were so many signs of it being the credit bubble of historical proportion. And also, there were some sober minds out there. Anyone who read your publication or Grant's Interest Rate Observer, anyone who read the annual reports from the Bank for International Settlements realized that there was something amazing going on.
Do you buy banks today?
No, we bought a few after the crisis, UBS, Goldman Sachs, Bangkok Bank in Thailand. Recently, the Brazilian stock market has been weak along with many other BRICS. So we've started buying into Itaú Bank. It's a pretty well-managed bank in Brazil. So yes, at the right price, we will buy a bank if we think that the underlying culture of the bank is good enough. I think Warren Buffett several years ago said the problem is that there are many more banks than bankers. There are very few people. It's a levered business, and there are very few people that have the right mind to properly manage those banks. And I think that Buffett was spot on, is still spot on. So whenever we pick banks, we try to find those that have a pretty good culture and a pretty good understanding of risk. In the case of UBS, the fact that they're moving more and more into private wealth management at the expense of lending is something that we've been welcoming.
You don't have very much. You mentioned you had a Brazilian stock, but you stayed away from what we call emerging markets.
Yes, because there is a paradox, which is that high economic growth does not always translate into good stock market performance. There are many reasons.
See that in China.
There are many reasons for that we see in China, but Steve, we have seen this even in the United States. I think of the United States in the middle to late 19th century as the ultimate emerging economy. America was so successful that by World War I, it became the leading economic superpower. Yet my history books somehow suggest that stocks did okay, but not that great. The big stocks were those big capital-intensive businesses that many of which exist in China, for instance, or Brazil. And they were, in the case of America, canals and railroads. And for all sorts of reasons, these companies did not do too well. 90% of them went bankrupt. In good American fashion, we made sure that it was mostly the foreigners that owned them, the Brits at the time. And so it's a paradox that is hard for people to grasp, but it's a reality.
Now, do you still fight equities when you feel you're not getting a good price? Bank of International Settlements is one example where you fought, and you've done some other. Do you still do that?
Absolutely. If we have to, we will be reactive. Now, ironically, we've had 3 battles in our past. Our first battle, oddly enough, was an American company. People always ask me about the risk of investing outside the US, and I, tongue-in-cheek, remind them that my first battle was against Kohler, Wisconsin, Herb Kohler. And he runs a wonderful business, by the way, but he had his own personal reasons to want to eliminate non-family members as shareholders. So he did a squeezed-out deal at a price that was not too nice, so we fought and succeeded. And yes, in the case of the Bank for International Settlements, they did a squeezed-out deal as well in 2000. The price seemed generous. It was 100% premium over where the stock was trading. Despite that generous premium, the price was still a 53% discount to liquidation value. In the case of most businesses, one can argue as to what the real value of the company is. In the case of the BIS, it was a liquidation value. I mean, it was very easy every day to compute what that number was. And the irony is that the Bank for International Settlements, which they claim to me, they try to be, do-gooders. They try to, preach good corporate governance, transparency, and yet they could not resist the idea of fleecing their own shareholders. And it was a 2-year battle, and we prevailed. And there's a book that came out recently written by Adam Lebor called the BIS, the Tower of Basel, that talks a little bit about that, but more importantly, traces back the history of the Bank for International Settlements since its founding in 1930, and it's quite a sinister history, and with Germany and the Nazis and so forth.
Bonds, you think they're a bubble today? You had a brief buying, as you mentioned, in 08 and 09. Are they still overpriced today?
I think they may be overpriced. Bubble, I'm not sure is the right word. I mean, in my mind, for a bubble to be a bubble, it has to be fueled on credit. I think people have been buying bonds out of fear, not out of greed. And I don't think people have been buying bonds on credit. So I would not call it a bubble, but I think the fact that people were willing to buy 10-year treasuries a few months ago when the yield was barely 1.7%, even though inflation expectations are for the next 10 years are that the CPI will probably rise at least 2.5% for the next 10 years, meant that people were willing to hold bonds knowing that they will lose money for the next 10 years. And the Fed themselves, in some various studies, have acknowledged that interest rates would be 1.5 points higher than when they were today, were it not for quantitative easing. Yes, so I think owning bonds today, buying bonds, does not make much sense. Having said this, I believe that the biggest risk right now in the world economy is China. They had a big credit bubble, especially over the past 7 or 8 years. That bubble is deflating. So I think there's more downside risk to the world economy than upside risk. I think it was this morning I was reading something about the fact that the government in China is asking for an audit to be done of what is the real size of the national debt. And so I think if there's a slowdown in China short term, that means that there's room probably for yields to go back down a little bit before eventually they go back up. But our belief, though, is that whatever policymakers have been doing over the past 6-7 years, governments with their fiscal policies, central bankers, will lead to inflation at one point. So we shy away from bonds as much as possible.
Which gets to gold. You said in 2011, I think, that gold was under-owned, even though it was 1,900. Now it's at a fallback. What do you see ahead? Is it just a temporary pause until central banks get back to their bad deeds?
Probably. Bear in mind that Chinese and Indians have become big buyers of gold over the past 10 years. Mm-hmm. And they have had mostly a good experience with gold. And so we have around 3.8%, 3.9% in gold. We don't think that anyone should have 10% in gold. It's probably too much. But because there are still risks out there, uncertainty as to what the final outcome will be of what's going on, whether it will be some deflation or a lot of inflation down the road, we think it's prudent to have some gold.
Insurance policy?
Insurance policy, and as you may have noticed, we have been adamant that one should own physical gold in lieu of gold mining shares. Gold mining is an extractive business, it's a dirty business, it's very hard, Mother Nature makes it very hard to find gold, it's very expensive to find gold. There are many countries where gold is being produced where the governments cannot help themselves but ask for higher taxes or higher royalties from those gold mining companies. So I think one is better off owning the metal than bother with the gold mining stock.
What's the marginal cost of an ounce of gold now?
Well, if you factor in,
Not cash, but the real costs.
Well, the cash operating costs are around $600 to $700. But if you want to add to that the cash replacement cost, the maintenance capex cash, you're talking about $1,200. And with gold being at $1,330, you don't have much of a cushion anymore. So it's a very highly levered highly speculative. Owning gold mining is a very speculative way of owning gold.
What's been the impact of ETFs on gold and silver, do you think?
Well, clearly the reason gold went all the way to $1,900 briefly in the summer of 2011 has been investment demand. It's been easier than before for individuals, pension funds, to own gold as an investment. So it has helped. It has helped gold, and I think it will keep helping it in the future. You can easily pick up your phone and call Merrill Lynch or UBS and buy yourself some gold ETF along with some IBM shares.
You've been partial to Japan for years, been active in that market. We chatted earlier about your ability to get in and out, but you're bullish now, not because of the recent elections there, but what you see happening on the corporate governance side, at least with some companies. Can you explain?
Yes, the Japanese market has been in doldrums for the past 25 years or so. They had a big credit bubble that started to burst in December of '89. The stock market fell 70, if not 80%. And so the Japanese market became extraordinarily cheap. In the meantime, over the past 20 years, companies have had the time to repair the balance sheet, so much so that the problem with most Japanese companies today is that their balance sheets are way too strong. Many Japanese companies sit on mountains of cash. Very little of it will be ever needed by the business. And so we have felt for a while now that the key to Japan was to see one day, hopefully, corporations realize that they have too much cash, and hopefully they would start to give some of that cash back to shareholders, either via higher dividends or increasingly stock buybacks. And then the next step, hopefully, will be more corporate activity, friendly takeovers, hostile takeovers. One interesting test right now is Sony. We've had in the past when American activists, I can think of even T. Boone Pickens back in the late 80s, when American activists have tried to do something in Japan, they were sent, back to the U.S. And I'm not suggesting that Sony has embraced, Dan Loeb from Third Point, but they've more than welcomed him. And in fact, I believe they've hired an investment bank, Sony has, to consider the merits of some of his proposals, and they may decide to take public one or two of their subsidiaries. So yes, we do believe that there's a huge change going on in corporate Japan, and that is the key for that market to go up a lot more than it has. Despite the recent rally, the Japanese market only trades at 1.1 times tangible book.
Now you, unlike others who invest in Japan, you like what you might call internal companies that are not the traditional big exporters.
Well, there's nothing wrong with the export companies. It's just that the domestic ones, the smaller ones, tend to be a lot cheaper in the stock market. Nothing wrong with Canon or Shimano at all. We've owned some of those, or Makita for that matter, which competes against Black & Decker. But the smaller ones, the more domestic ones, are far cheaper, and so that's where we have put a lot of our emphasis. Some of these stocks have done very well. Yahoo Japan, that's a strictly domestic business. The stock has more than doubled over the past 2 or 3 months. Temp Holdings is a temporary staffing business like a Kelly Service or Manpower. That stock has more than tripled over the past 9 months. So even smaller domestic names.
Company there too.
Our biggest holding is Astellas Pharma. It's a pharma company, global. More than half their earnings come from outside Japan. And they've been unusually un-Japanese in the good sense of, for many years, they've been willing to pay high dividends. Roughly half their free cash flow they're willing to pay in the form of dividends. Over the past 8 years, they've been willing to buy back over 20% of their shares. That is un-Japanese. It's very impressive. Whenever they've made acquisitions, they've been very careful not to overpay. And there are still, even though the stock has done well, we feel that the locals, investors, don't fully understand the company. They don't understand the EBIT as reported is a lot less than the real EBIT. There's an amortization of goodwill.
Especially with Japanese companies, a lot of companies, cash laden, and therefore you have to adjust real returns.
Yes, I mean, oftentimes a Japanese company will show low return on equity, but if you strip out the cash, you'll realize that the business itself does have a very high return on capital employed. So there are many fine Japanese companies where the attractiveness of the business, the profitability of the business is is hidden by the fact that you, next to the business, you have a pile of cash that dilutes the return on equity. And likewise, from a valuation standpoint, if you look at Japanese stocks just from a pure and simplistic price to earnings basis, as opposed to an enterprise value where just the market cap for the cash, this is how you notice how cheap some of these stocks are.
Now, let's go quickly to some individual stocks. One that you have not bought, which you owned years ago, talking about having a lot of cash, but it doesn't meet your criteria now, apparently, is Apple.
No, because we acknowledge that the stock looks cheap. We just question the sustainability of those margins. I remember 2 years ago hearing people talk about all these applications providing some sort of moat. Not sure there's much of a moat, frankly. At the same time, but recently though, we've sold some puts that mature in early 2015. Strike price $430 and $440. We got paid $60 and $70 premiums. So we've established, we've tried to create an entry price into Apple at $360 per share. And hopefully, but it's a small position. Our level of conviction, frankly, is low. We think competition will heat up, and we think their margins will come down significantly.
What about Microsoft? There's a stock that's done nothing for.
Well, it's done nothing. A few years ago, we were able to buy it in the mid-20s. It may be helped by the activist Jeff Ubben from Value Act. The stock was at $34, $35 a few weeks ago before the recent pullback. We've trimmed our position nicely. We have mixed feelings about it. The outlook for the business is murky. We're not big fans of top management. Conversely, we're able last year to buy Google very cheaply, even below 600. Now the stock has done well. It's almost priced as a growth stock today, but we think that that business, the moat of the Google business is very strong, and hopefully they'll have nice tailwinds. In the technology arena, the stock that has where we've been able to add quite a bit recently has been Oracle, which in fact.
Now everyone says the cloud will do them in, but you don't believe it.
We don't believe that. I hope we're not missing something. From a valuation standpoint, it's much cheaper than even Microsoft. Enterprise value to EBIT is 7.2 times. They've been wonderful capital allocators over time. They've not diversified. They've not tried all these things Microsoft has tried to do, and typically unsuccessfully. Microsoft, that is. And yes, we think those concerns regarding the cloud are overblown. What they offer, they work mostly with Fortune 500 companies, many governments. They offer very complex software solutions, and we think that they will be needed, their services will be needed by the clients going forward.
Company most Americans don't know, Wendell.
Well, Wendell, don't blame them for not knowing, is a French holding company controlled by a family. Even though I preached the virtues of eating their own cooking, they, during the bubble a few years ago, couldn't help themselves, but they made a mistake. They used some leverage and bought a wrong asset. So the company got levered. We're able to buy some high yield bonds in 08, 09 during the crisis, when those bonds were yielding 18%. These bonds are maturing in 2015, 16, 17. Now these bonds have done well, but they still offer a yield of 4.5%, 5.5%, which is still 300-400 basis points over French government bonds. So we're happy to hold on to these bonds.
Expeditors International.
For many years, we owned a competitors of them called Kuehne and Nagel, which is a Swiss-based yet global freight forwarding company. Kuehne and Nagel, maybe because the float was limited, always traded a big discount to Expeditors. Today, it's the other way around. Expeditors is cheaper than Kuehne and Nagel, and that stock used to be held by growth investors that like the fact that world trade grew a lot faster than world GDP. Right. That growth has reduced significantly, but the stock, the multiple at which the stock trades has contracted significantly. So we think it may not be as growth of business, as it will not grow as much as in the past, but it's still a fantastic business. They don't own the ships, they don't own the airplanes. It's a service business. It's not capital intensive. They generate significant free cash flow. And they've been wonderful capital allocators of capital in the past. A few months ago, top management noticed that the stocks was undervalued, they took advantage of it by doing a pretty sizable stock buyback, and we would expect more of that going forward should the stock keep languishing.
Berkshire Hathaway, old favorite.
Berkshire is a strange stock. A year ago, the market seemed to hate them because they did not pay a dividend. They still don't pay a dividend, but a year ago, the discount at which that stock traded was huge, and we bought a lot more of it at the time. But I think since then, Mr. Buffett has been willing to up the price at which they would consider buying back their own shares. Now they're willing to pay up to 120% of reported book value. And also they've shown, including recently with the Heinz deal, an ability to still do smart deals. And the stock has been rewarded and now trades much closer to its entrance value estimate. Now, we still think that they can still compound wealth over time. We think intrinsic value can still grow over time, but the discount has narrowed, so we have trimmed our position over the past few months.
Other stocks that excite you now?
Well, Nestle is a very boring stock. It's a food company, but it's an extremely well-managed food company, very global. 40% of their earnings come from emerging markets, now which is typically good. Now it's not good when the underlying currencies of these markets go down. Recently the Indian rupee has come down. Recently the Brazilian real has come down. But still they have exposure to these vast, fast-growing economies. And the stock trades at a very modest multiple. So it's a very boring stock, but we're very comfortable holding on to it.
Charles, thank you very much.
You're welcome, Steve. I enjoyed it.